we do think that, on balance, it does look like you're going to see a recession, but we're definitely in the camp that it is going to be a mild recession. And we're not certain that the recession is going to be deep enough to get the Fed to cut rates, given we think inflation is going to prove pretty sticky. So, you've got this balancing act by the Fed. And what I think the Fed won't want to do is sort of reinforce market expectations that actually they're definitely going to be cutting rates in the second half of the year. When, every statement they come out with so far has been, we're not going to be cutting rates. So I think that, it's going to be where we go from rates from here. It depends on the economy, depends on growth, depends on inflation, depends on the banking sector, and it's data dependent.
Yeah, Rupert, you've just made note of quite a bit when it comes to that data. We've spoken about jobs market a little bit more. So has the discussion become a little bit more than just about inflation then for the Fed? And does that kind of risk its credibility somewhat? Because inflation isn't still where they want it to be.
I think their main concern is still inflation. And the big question is, to what extent will they tolerate a mild recession if inflation is still sticky? And that is still very uncertain, what the trade-off for the Fed is between sort of how big a rise in unemployment are they prepared to tolerate. And in terms of the labour market, we have the, as you've mentioned, sort of job vacancies falling more than expected this week. But, only last week we had news that wage inflation is actually remaining higher than people had thought it would do. So again, there are definite signs that the labour market is slowing. Is it slowing fast enough to get wages back under control as fast as the Fed wants? Arguably, still it's not.
Yeah, this feels almost like a Pac-Man effect, if I can call it that, when it comes to the banking saga out in the United States with these regional lenders, that we move from one lender to the next and the next weakest link, if you want to call it that. Jamie Dimon saying that we're near the end of this banking crisis. Would you agree in any way, or perhaps a little more of the dominoes to fall here?
In terms of the smaller regional banks, I don't think we're at the end of the process yet, partly because a lot of the strains there for these banks in terms of deposit outflows, the only way they can really sort of remove that threat is by providing unlimited deposit insurance, which they're not going to be able to do because it requires Congress to act, and that's not going to happen. And the other thing which is undermining the regional banks at the moment is their exposure to commercial real estate. And again, that sector is in decline and is going to remain in decline. So the sort of individual bank perspective, I don't think these problems have gone away. In terms of it posing a systemic risk to the economy overall, I think sort of the Fed has definitely done enough in terms of the response to prevent that. So, on a localized basis, it's going to continue. But in terms of sort of the sort of fears which we had sort of 2 months ago, this is all going to spiral out of control, I think generally those fears have gone away, and Jamie Dimon's right.